DTCC is tokenizing US stocks, but not in the way crypto expected. Something significant has just happened inside the infrastructure that supports the American stock market. On the 15th of July, DTCC converted securities already held inside the traditional financial system into digital tokens and used them in real production transactions. These were not test assets on a demonstration network. The transactions involved real securities, real financial institutions, and real market workflows. And DTCC says its tokenization service is now scheduled to launch in November 2026. That sounds like the moment stocks are finally moving onto blockchain. But there's an important distinction here. Because DTCC is not announcing that the entire American stock market will suddenly become tokenized in October. It's creating a system in which eligible securities can move between their existing traditional form and a blockchain-based representation. That initial list could include shares from the Russell 1000, ETFs tracking major indices, and US Treasury bills, notes, and bonds. So today I want to explain what the DTCC has actually done, what will launch in October, which assets could be included, what owning one of these tokens could mean, and whether we're genuinely approaching a future where stocks trade around the clock on blockchain infrastructure. Because this story is much bigger than simply putting a share certificate on a blockchain. It's about changing how assets move through the financial system. So firstly, what exactly is the DTCC? Most people buy and sell shares without ever hearing the name DTCC. You open an investment app, buy a stock, and see it appear in your account. But behind that simple transaction sits a large network of exchanges, brokers, custodians, clearing houses, and settlement systems. The DTCC, the Depository Trust and Clearing Corporation, operates crucial parts of that infrastructure. Its subsidiary, the Depository Trust Company, or DTC, holds securities for financial institutions and records the entitlements those institutions have to those assets. DTCC says DTC currently custodies assets valued at more than $114 trillion. That figure is important, but it needs to be presented carefully. DTCC has not said it's about to tokenize all $114 trillion. The significance is that the organisation holding and supporting that enormous pool of traditional assets is now building a route through which some of them can be represented and used on blockchain networks. This is very different from an independent crypto company creating a synthetic token that tracks the price of a stock. DTCC is working from inside the existing regulated securities system. So what did happen on the 15th of July? DTCC says it converted securities held at DTC into tokenised representations, something described as digital twins, and then used those tokens in several real production trades. More than 30 firms participated across traditional finance and the digital asset industry. The transactions covered several practical market activities, including an equity trade using delivery versus payment, a US Treasury and repo transaction, securities lending, collateral pledging, an equity token transfer, and central counterparty margin processes. In simple terms, this was not just a demonstration that a token could be created. DTCC was testing whether tokenized assets could actually perform some of the jobs securities carry out every day inside financial markets. Could they be transferred? Could they be exchanged against payment? Could they be pledged as collateral? Could they work in lending and margin processes? And could all of that happen while preserving the controls and investor protections associated with the traditional system? The conversions were conducted on DTCC's private network, Based on LF Trust's decentralized Trust Besu technology and on the Canton network. This was part of what DTCC describes as a multi-chain strategy. It doesn't want the service to depend on one blockchain. That also means this announcement is not confirmation that DTCC has selected XRP, the XRP ledger, or any other single public token as the universal settlement asset for tokenized securities. Ripple's Prime was named as a member of DTCC's wider industry working group earlier this year, but participation in that group is not evidence that XRP is being used in these transactions. That distinction matters, particularly when social media posts move faster than the underlying facts. DTCC plans to launch its tokenisation service in October 2026. The service will allow participating DTC members and their clients to choose to convert eligible securities held at DTC into tokenised form. The traditional security does not disappear. Instead, DTC moves the participant's conventional entitlement into a designated account and creates a token that represents that entitlement in a registered blockchain wallet. That token can then be transferred into another approved wallet belonging to another participating institution. It can also be converted back. When that happens, the token is burned and the security entitlement returns to the participant's conventional DTC account. This is why it would be misleading to say that DTCC is permanently replacing traditional stocks with tokens. The model is designed to let eligible assets move between two forms. Their familiar book entry form inside DTC's existing ledger and a tokenised entitlement recorded on an approved blockchain. The tokenised version is intended to retain the same ownership rights, investor protections, and economic entitlements as the traditionally held asset. That includes the relevant rights associated with the security, although some corporate actions may initially require the asset to be converted back into conventional form while the service develops. So, which assets will be eligible? Under the SEC, no action relief granted to DCC. The initial eligible universe includes highly liquid assets. That covers the constituents of the Russell 1000, which represents roughly 1,000 of the largest publicly traded US companies by market capitalization. It also covers ETFs tracking major indices and US Treasury bills, notes, and bonds. That creates the potential for tokenised representations of some of the largest companies and most widely used government securities in the world. But eligibility does not mean every one of those assets will immediately be tokenised. Participation is voluntary. A DTC participant must choose to use the service, register approved blockchain wallets, and decide which eligible securities it wants to convert. Demand will therefore develop gradually. Some institutions may use tokenised treasuries as collateral, others may experiment with equities, securities lending, or trading arrangements. Some may initially decide that the traditional system still meets their needs. October is the beginning of the commercial rollout, not a deadline by which American stocks must be placed on blockchain. There is currently no confirmed date when every eligible stock will be tokenised, and there is no guarantee that every stock ever will be. But what could tokenisation improve? The potential advantage is not simply that a stock becomes a digital token. Traditional securities are already digital. The potential value comes from putting ownership entitlements onto programmable networks where assets, money, and contractual instructions could interact more directly. One possible advantage is collateral mobility. Financial institutions hold enormous portfolios of securities, but moving those assets between systems and counterparties can be operationally slow. A tokenised treasury could potentially be transferred or pledged more quickly, allowing an institution to use its assets more efficiently. Another possibility is extending operating hours. The traditional US stock market has defined trading sessions, and many post trade processes operate within established business day windows. Blockchain networks can operate continuously. That does not automatically mean every tokenized stock will trade 24 hours a day from October. Trading hours depend on exchanges, broker access, liquidity, regulation, payment arrangements, and risk controls. But the infrastructure could eventually support longer trading windows. Tokenization can also make assets programmable. A transaction could potentially include rules determining who's allowed to hold an asset, how it can be transferred, and what must happen before settlement completes. That may reduce manual reconciliation between institutions because participants can share a more synchronized record of ownership and movement. The ultimate aim is often described as atomic settlement. The asset and payment change hands together, reducing the risk that one side delivers while the other doesn't. But this is where we also need some balance. Faster settlement is not automatically better in every circumstance. Markets currently benefit from mechanisms such as netting, where multiple obligations are combined before final settlement. That reduces the amount of cash and securities institutions need to move. If every transaction was settled individually and instantly, firms could require more liquidity rather than less. The industry therefore has to work out where near instant settlement creates value and where existing market structures remain more efficient. So, who will be able to use it? This service is initially designed for DTC participants and their clients. It's not being launched as a retail app where an individual investor connects a personal wallet and withdraws tokenized shares directly from their brokerage account. Participating institutions must register wallets on blockchains approved by DTC. Those wallets operate inside a compliance framework that includes identity controls, sanction screening, and restrictions on who can receive the tokens. So, although some of these assets may exist on public blockchain infrastructure, that does not mean that they will become freely transferable to anyone with a wallet address. This is permissioned access layered onto blockchain technology. That may disappoint people who imagined Wall Street adopting completely open and decentralized markets, but it also explains why large regulated institutions may be prepared to use the system. They want the flexibility and programmability of blockchain without giving up legal certainty, compliance controls, custody arrangements, and the ability to reverse or correct certain operational problems. So, where does Stellar fit in? DTCC has also announced plans to make DTC tokenized assets available on the Stellar network during the first half of 2027. Stellar is a public blockchain, so this represents a meaningful step beyond private institutional networks. DTCC says the integration is intended to support conversion between traditional and tokenized form, corporate actions, and reporting across the full life cycle of an asset. However, this should not be interpreted as every Russell 1000 stock automatically moving onto Stellar in 2027. It means Stellar is expected to become one of the approved networks through which participating institutions may use eligible DTC tokenized assets. It's also important to distinguish the Stellar network from its native token XLM. The announcement confirms planned use of the network. It does not state that XLM will become the settlement currency for all tokenized US securities, or that the value of those securities must flow through XLM. Network adoption and token value are related questions, but they're not the same claim. So, why is DTCC taking a multi-chain approach? Financial institutions do not want to build a new market that becomes trapped inside separate blockchain islands. If tokenized assets exist on one network, but the cash, collateral, or potential buyers are located on another, the market remains fragmented. DTCC's strategy is focused on interoperability, allowing assets to move across different approved systems while preserving a consistent legal record and set of controls. The July production transactions used both a private network and Canton. Stellar is expected to follow in 2027, and DTCC has left the door open to other approved Layer 1 and Layer 2 networks. This means the long term competition may not simply be about which blockchain can host a token. It may be about which networks can satisfy institutional requirements for privacy, identity, compliance, resilience, and interoperability. The winning infrastructure may be the infrastructure that institutions can connect to without rebuilding their entire operating model. Now, does this make traditional exchanges obsolete? Not anytime soon. Tokenising an asset does not automatically create a liquid market for it. You still need buyers and sellers, pricing, market makers, regulated trading venues, brokers, and mechanisms for protecting investors. NYSE, NASDAQ, and other established platforms already concentrate enormous amounts of liquidity. Tokenisation could change how assets are held, transferred, and settled without immediately replacing where investors trade them. Over time, it could also enable new trading venues or allow regulated markets to extend their hours. But the most realistic early impact is likely to appear behind the scenes. Retail investors may notice very little at first. The first benefits may go to institutions using tokenised treasuries and equities for collateral lending, treasury management, and settlement. That may sound less dramatic than saying the stock market is moving on chain, but it's arguably more important. Financial infrastructure often changes quietly before the public facing product changes at all. So, what could go wrong? This system introduces new technical and operational risks alongside its potential benefits. Smart contracts can contain errors. Blockchain networks can experience outages or congestion. Institutions need secure systems for managing wallet credentials. Different networks must remain synchronized with DTC's authoritative records. There are also legal questions about what happens if a token is transferred incorrectly, a wallet is compromised, or the blockchain record conflicts with the central record. DTCC's model retains a central role for DTC precisely because regulated markets require somebody to be accountable for those situations. The SEC's no action relief is also time limited. The DTC has been authorised to offer the defined service for a 3-year period under specific conditions while regulators and the industry gather evidence about how the system performs. This is not an unrestricted approval to tokenise any asset in any way. The eligible securities, participants, wallets, blockchains, and tokenisation protocols all operate within defined controls. That makes the launch significant, but still carefully contained. The bigger picture? For years, the tokenisation narrative was led largely by crypto companies, describing a future in which traditional finance would move onto public blockchains. What we're now seeing is traditional financial infrastructure building its own bridge into that future. DTCC is not abandoning the existing system. It's taking securities already held within that system and giving institutions another form in which to use them. That may be the real model for institutional tokenisation, not a sudden replacement of Wall Street, but a gradual blending of traditional custody, regulated ownership, and blockchain-based movement. October 2026 will not be the day the entire stock market becomes tokenised. It'll be the start of a controlled commercial service through which selected institutions can convert eligible stocks, ETFs, and treasuries into tokenised form and use them in approved blockchain environments. The first half of 2027 should then bring planned access through Stellar, adding a public blockchain to DTCC's developing multi-chain system. After that, adoption will depend on whether institutions find genuine value in the technology. Do tokenised assets reduce costs? Do they move collateral more efficiently? Can markets operate for longer without creating new risks? And can different blockchain networks work together without fragmenting liquidity? Those are questions that will determine whether tokenization remains a specialist institutional tool or becomes the infrastructure underneath a much larger part of global finance. So, when you see claims that DTCC is about to put the entire $114 trillion market on blockchain, be careful. That's not what's been announced. But the accurate story is still enormous. One of the most important institutions in global finance has processed real transactions using tokenized stocks and government securities, and it is preparing to launch that capability commercially. But the financial system is not being replaced overnight. But one of its central pieces is now learning how to operate on chain. And that may tell us far more about the future of tokenization than any price prediction ever could. Let me know what you think. Do you see tokenized stocks becoming a normal part of investing? Or will the technology mainly remain behind the scenes for institutions? If you found this video useful, don't forget to hit the like button, subscribe to the channel, turn on the notifications, and if you do see the hype button, please press it. It really helps the channel. Thank you so much for watching, and I'll see you in the next one.